Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter, taking a look at a follow-up on our previous look at why IV matters, where a big drop in implied volatility with the market at all-time highs kind of signaled maybe it was time to take a look at some puts. Lo and behold, 2 days later, that proved to be prescient. So let's jump in and take a look. First of all, here was the day we were looking at it with the S&P basically on the all-time highs. We did that comparison, right, going back in time for the SPY at 636 with the VIX, right, under 15 trading with a 14 handle. Just how cheap things have become. That's 635 basically at the money put. This is in our previous video, trading at 836. Compare that to when the VIX was trading over 40, right? And the SPY was under 500. That 495 at the money put, right? Basically triple the price. We did a similar thing, long-term in nature, right? The a little further out, but basically slightly out of the money put, trading at 1216. This is going back to July 29th again. Compare that when we had the SPY trading under 500, the VIX again over 40. We can see that similar 490 put, right, trading at basically double the price, right, even with more days to expiration now versus then. So let's jump in and take a look. What would happen if we took advantage of the fact we saw the VIX basically at yearly lows, the market at all-time highs, thing getting a little complacent? We said, hey, maybe it's not a bad time. Put in some put protection or take a bearish stance with buying slightly out of the money puts. So lo and behold, that proved to be the case. So here was from July 29th, midday, SPY at 636.43. Days to expiration, these are the September 5th, 38 days. The 635 put, just slightly out of the money, trading at 836. IV at the time was 1226. We recommended just basically buying some of these puts just as a protective play and or a trade. Fast forward to today, right? So August 1st, right after the open, about a half hour into trading, you can see that the SPY dropped to 621.24, right? Or about 2.5% just underneath that. That 635 put, though, now trading at almost $18, right? So if you would have been able to buy it under 9 back here and sell it at almost 18, more than doubling in price, right? Gain of over 9.5 points, or more than 100% gain, with the SPY dropping a little over 2%, right? Then why? The big reason, on top of the fact, right on the call, right, IV exploded by over 14%. So IV on these options now over 14, back then approaching 12. The longer term trade, same thing here, July 29th, we took the same reading, right? These ones a little longer in time, had 80 days to expiration, so this slightly out of the money put, right? Trading in this case at a price $12 and change, right? Lo and behold, today at virtually the same time, right? About a half hour into trading, right? That same 2.5% or so drop in the SPY led to that 630 put, right, which now has a couple less days to expiration because a couple days have passed, now trading over 20. Back then, you could have bought it at basically a little over 12. Now sold a little over 20, making almost $8 on it, right? Or about a 65% gain, certainly less than that 100 plus on the shorter term ones, right? So that's why you're seeing a lot of people flood into the short term, because you can really lever up. But if you're wrong, you have a lot of time decay, and you can lose everything more quickly on that. So depending which expiration you choose depends on your kind of risk reward tolerance. But this one's still certainly a very nice 65% gain in just a few days with the SPY dropping a little over 2%. More importantly, that IV now jumped to over 15 back there. It was under 15, so also a benefit, a nice jump of about 7.5% on IV. So the shorter term trade, you could have made over 100% net gain in a couple days by just saying, this market's getting a little bit overdone as far as price action, a little bit overdone as far as cheapness of IV, implied volatility. Implied volatility, as we know, is the price of the option. Not a bad time to take a kind of bearish counter trend position, and it certainly worked out in spades here very quickly. So just shows kind of the insights we use here to kind of day in and day out look for opportunities that put the probabilities in our favor, because at the end of the day, trading is all about probabilities, not certainties. Take care.